We're Compound Everything. We talk money, markets, and investing. And this week we are talking about the investment philosophy and the lessons that we can learn from Chuck Akre.
So we came across him a little while back, not quite sure how, but one of the things that stuck with us was his philosophy. And it's actually quite simple at its roots, but I mean, there's obviously going to be some intricacies there. And he talks about something called a three-legged stool as his investment approach. So he developed this system, I guess, because his father, I'm not sure how this came about, but his father gave him a milking stool or something like this. And that's the idea. I guess he likes farming and whatnot. And somehow he got this three-legged stool and he thought, hey, that's a good picture representation of my investing philosophy. Now, the interesting thing about a milking stool is that if you are a farmer and you're sitting on a milking stool, you don't have very far to fall if you fall off the stool while you're milking your cow. So I guess that kind of personifies or alludes to as a metaphor for the market, and he doesn't really want to fall too far if he's wrong on some of his investments. Makes sense. And the other thing actually is, interestingly enough, is a three-legged stool is actually more stable than a four-legged stool. So just by virtue of it having three legs, it's actually more stable than a four-legged stool. So I thought, oh, that's
that was actually something I learned. I didn't know that.
Yeah, I didn't know that either. And so 3 legs to the stool, and why don't we go through those?
Okay, so what are the three pillars of his investing philosophy?
Okay. So the 3 pillars are business, management, and reinvestment.
Yes.
So what they're looking for is enduring, predictable, high return on equity and free cash flow for the business part of things. In terms of management, they're looking for honest management who has proven themselves in terms of a track record, in terms of being able to make good investments. And the third thing they want is the ability for the business to reinvest. And so what they're usually looking for is smaller businesses that generate significant free cash flow, and they can take that free cash flow and they can either reinvest it organically or they can invest in acquisitions. So that's the 3 legs.
I feel like every big investor has the same type of philosophy, a lot of crossover in their investing style, and that's what kind of led us to talk about Akre, is that we were like, oh, he has some kind of the same investing styles as these other guys, and these are just time-tested and proven investing philosophies that tend to work. And they all have little things they do a little differently and tweaking here and there, but the overall arching philosophies are the same. So why don't we go over his returns?
Sure.
Like what's his track record?
That's great. I was just going to go there, actually. So he began in the 1960s, actually. He started as a stockbroker, and I think he ended up starting kind of going out on his own in the 80s. And so the returns I have don't span that far back, but
he started his own fund in 2009.
Yes, and so he started his own fund in about 2009. The returns that he's managed to generate from 2009 is just over 15% per year, compared to the S&P, which is right around 14% for that same time frame. So he's actually handily beaten the S&P 500 in that regard. And actually, if you go back a little further, I think you had done a little bit further digging when he was actually on his own from about 2000 to 2009, where he actually handily beat the S&P in that regard.
So he had another fund that he was running. I don't know if he was on his own yet or not.
Okay,
I think he was
enough.
actually working for a firm.
Oh,
I think he started his own fund
that's
in
okay.
2009.
Okay.
But he was running this other fund, and now you have to remember the S&P went through the dot-com bubble during this time frame, and it also went through the great financial crisis.
Yes.
So his returns while running this other fund were 11 point something percent, and I think the S&P at that time was like under 4%.
Wow.
So he really beat the S&P.
So he beat the pants off it at
Yeah.
that point. So those are his returns. So the interesting thing about Chuck Akre is that he actually doesn't come from a background of finance. He himself said he was a pre-med major and actually ended up majoring in English, and then ended up transferring into, I guess, finance as a career because I guess he enjoyed it.
A lot of the people we've covered actually don't have a history in finance because Shelby was a historian.
Yeah, I think he was a history major.
A history major,
Yeah.
and then you have Manish.
Yeah,
Kabrai,
he was an engineer. Yeah.
And
George Soros, I think.
Yeah, like a lot of them don't have a finance background, which is very, Michael Burr, I think, is an MD.
He's an MD.
That's right. So it's very interesting because it just, a lot of these guys find themselves in finance, even though they've studied other
professions and gone into maybe other career paths to start.
Hetty Green, that's another one.
Yes, that's right. That's right.
So, yeah.
So Chuck Akre has a bit of an unconventional approach, it sounds like, to investing. And what I mean by that is kind of where he locates his head office. His head office is somewhere in Virginia, like rural Virginia.
I think he's on a farm.
Yeah, he's on a farm, and I think his office is in a smaller town in Virginia I've never heard of. So, not that I've heard of a lot of places in Virginia, but at the same point, he's not in New York. One of the main reasons he says for that is because he said, if I was living in New York, there'd be people who have these very interesting stories, and I might get bogged down in that. And he says it would take me away from what I'm good at. And so he knows he's good at kind of using his three-pronged approach to pick businesses, and so he just decides to stick with it, and it's worked for him. The other thing that's interesting about him is that he was heavily influenced by, you can guess, Warren Buffett, but also he was very heavily influenced, and maybe even more so influenced by a book, which, funny enough, we've just profiled, which is Thomas Phelps's book, 100 to 1 in the stock market. And I think he was pretty profoundly influenced by that book, and just the idea that you could generate significant returns just by holding for long periods of time. And if these businesses can, again, generate high returns on capital and high returns on equity, then that will generate huge price changes in the stock.
And one of the things that when I was listening to him that I kind of picked up on is that he actually doesn't go into it with an exit strategy.
That was interesting.
And he wants to hold forever, and that is very much 100 to 1 in the stock market thinking. Is like you have to hold for decades, and if you want to learn about that book, we actually did a video on it last week.
Just last week.
You can go and watch that one, or you can read the book, which would probably be better. But he says we don't go into it with the idea of selling.
Yeah.
And I guess they're confident in that because they have done so much homework.
Yeah.
And I think when asked, like, I don't know if the word was edge, but they said, like, what is your edge, or what is like, what do you do differently? And he said, we study and we read.
Yeah, they read, they study. And the other thing he said is one of his advantages is they don't sell. And in his letter, there's actually a letter from him that you can find on the Akre Capital Management website. So in that letter, he talks about the fact that the less decisions they have to make about investments, the less mistakes they'll probably make. Now, they have to be confident going in, but if they do their due diligence, they do their research, they should have what they need in terms of, buying the stock and, having a good decision there. And so making more decisions makes you more prone to error. And I just thought that was an interesting takeaway point from his 1988 letter.
What was interesting to me about the 1988 letter is so in doing newer research on him and listening to newer interviews with him, nothing's changed from
it's
that
the same.
letter, which made that letter even more intriguing to read because he still has the same philosophies, he still goes by the same metrics. So that being said, why don't we get to the pillars of his investing philosophy?
Sure.
So the first pillar is it has to be a good business. And he talks about, at one point I listened to an interview with him and he was talking about like the quantitative part, but he said it's actually they look at that kind of like screener.
Sure, obviously.
Right?
Yeah.
And then it's actually the qualitative that takes him a long time to figure out because that's the hard part, right? And we've talked about that before. I think it's, is it Ted Coons who says they spend most of their time talking about moats?
Yeah.
So here's a list of things they look for in a good business. They see their profits in cash. They are not natural targets of competition. They have freedom to price their products. They are understandable. They do not take a genius to run, and they earn very high return on capital and assets. And in a recent interview with him, one thing I actually took away, and he never says this anywhere, but I was like, oh, this is obviously important to them, is that he likes oligopolies.
Yes. He mentioned that kind of an idea, just as an aside throughout the interview that we listened to.
Not even as an aside, he kept talking about his positions, and he's like,
That's
oh,
true.
they're an oligopoly, oh, they're an oligopoly. And I think we counted 4 in the interview, and I was like, okay, that's obviously something, whether he's identifying it or not, that is something that should be on that list.
Sure, exactly. And I mean, oligopolies, like current examples, you can think of that in terms of retailers would be something like Home Depot or Lowe's, and businesses like that. But it was interesting to hear him reference oligopolies because I think he likes them because they have pricing power. So
you can tell in that list that I read that he's definitely a student of Warren Buffett because he says things like, it doesn't take a genius to run. And I think it's Munger who said, you want a company that any idiot can run because one day one will.
Yep.
And then he talks about moats.
Yes.
Right? And he talks about clean balance sheets, and that's always also Buffett-esh. So you can continue on with the qualitative part.
Yeah, I think they look a lot for businesses that have strong balance sheets. They're not looking for companies that are heavily laden with debt. They're also looking for ones that have readily identifiable competitive advantages. They want to see it has to be obvious to them. I think again, Warren Buffett talks about jumping over 6-inch bars, not 6-foot bars, and so I think that's kind of a similar philosophy that Akre has in his investments choices as well.
So one of the points that was interesting was they're not natural targets for competition. And we recently listened to, and I can't remember his name, but it was an interview with the author of the Powers book or something like that.
Yes,
I can't remember
7 Powers.
The 7 Powers, yeah. And he talked about barriers. And that's kind of like the point I got from Akre here. And it's like, okay, and he said it's not necessarily what they do that's important, it's the barrier. What are the barriers to get in?
What's keeping the other businesses out?
Right. And I thought, oh, that's something we really do have to pay more attention to, and that's probably why he likes oligopolies. Oligopolies are oligopolies for a reason. No one's been able to
penetrate it,
right? Like you mentioned Home Depot and Lowe's. And they literally really, like, we used to have quite a few little like hardware shops here. They're gone.
Yeah.
And no one's really tried to come in and take out Lowe's or Home Depot. Yeah. Why? It must be a pretty incredible barrier that they've set up.
Yeah, I think it must be. Well, yeah, because if there's money to be made in an industry, that people are going to try. So people are going to see that this business is doing well and it's making high returns. They're going to want a piece of it.
Right. But there must be people who have tried to break into some of these oligopolies, but they just cannot.
They just can't get it.
Right. So the barriers. What are the barriers? So that was an interest. I digress, but.
Yeah, and I think they spend a lot of time looking for those and identifying those kind of barriers. And they want to buy companies that they know are going to be generating high returns on capital for years, if not decades. Right. And that's their interest in an investment. And as you alluded to before, they don't go into it looking for an exit strategy.
No, they're long-term holders.
Typical value investing, you'll go into it, you buy $1 for 50 cents, and then you're going to sell it when it gets to 80 cents on the dollar, and I've made my money and I'm out. But this kind of high quality business investing, that's not the idea that he has.
Yeah.
So he mentioned, almost as an aside, what would make him exit a business, and that was essentially if there's been a fundamental change in the business, or maybe the management was someone they couldn't trust anymore, or perhaps, and along those same veins, if the business may be getting more competition, they're losing their moat or competitive advantage. Those are things that would maybe make them think about selling.
Yeah. So the usual.
The usual
for these guys.
Yeah. So the second point of the three-legged stool is management. So what they're looking for is trustworthy management who has a good track record. So someone they can trust, essentially. And I think one of the things that he stressed there is he wanted to be treated like a partner in the business, even though they never met management, or management has never met them. And that really jumped out at me. And that's kind of the boat that we are in as small-time investors.
And one way, if you want to know if a manager is shareholder friendly, because it's hard.
It's tough.
He can jump on the phone and call these guys.
And they'll answer his call.
And he said that one thing that's like a total turnoff is when the CEO starts talking about the stock price. He's like, that was like a red flag to him. He's like, I'm not interested in that.
Yeah.
I'm interested in return on capital.
Yeah.
And he said, like, they are just like, that is something they listen for. And if they ask questions and they start talking about the stock price, or he said if like they walk in and the ticker's up on their computer screen, he's like, nope, we're not nope, that's not the management we want. But I have found, and we've mentioned shareholders letters before, but even beyond the shareholders letter, does the shareholders letter break down the company in a way that you can understand?
Yeah.
And I have found that you can actually read shareholders letters and tell if they're just trying to sound smart.
Yes.
Or they're trying to hide why they had such a horrible year.
Yeah.
Or why they've been sucking.
Yes.
You can actually, the more shareholders letters you read, the more you're able to identify a CEO who's just a mercenary.
Yes.
And a CEO who actually wants to partner with his shareholders.
Yes. So the shareholder letter should be written for us as investors who don't necessarily know the in-depth workings of the business. And so from that standpoint, they should be able to communicate it to me in a way that I understand.
Yes.
As an outsider. Funny enough, we actually had our daughter read two shareholder letters. One was a good example and one was a bad example. Yeah. We had her read the Intel shareholder letter, which was a bad example, and she stumbled through it. But we had her read the Foot Locker shareholder letter by Mary Dillon, and she got through it without an issue. And she's 12 years old.
Right. Now that being said, those aren't exactly too fair head to head, because I mean, Foot Locker is very easy to understand.
Yes.
Semis aren't easy to understand.
I agree with
so
you.
I wouldn't necessarily put those head to head. But I will say that the shareholder letter by Pat Gelsinger is not well written. It's not shareholder friendly.
It's the language that's used.
It's more so like he's waxing eloquent to show his superiority, to show how smart he is.
Yes.
It's ick. It just gives me the general ick feeling.
Right. You can tell in the language that's being used.
Yes.
Are they trying to explain this in simple terms to me, that in terms that I understand as a kind of an outsider, but fellow owner of the business, or are they actually trying to explain it to me in a sense that they're trying to obfuscate things?
Or they just want to be like that CEO. Like, it's not even that he's trying to explain anything. I just get that he's a proud person writing a letter to showcase his own intelligence. But that is not the purpose of the shareholders letter.
Right. So I think at that point, you can tell whether the CEO is more interested in actually growing the business, or if they're more interested in short-term stock fluctuations and what analysts are going to think and whatnot. And you really probably don't want to partner with those people. You want to partner with the first one, who's actually trying to build the business, especially if it's good. And often who has a vested interest in the business as well. So they also look for businesses where the CEO compensation is rational. So
Hard to do now.
It's hard to do. It's hard to do now. But the compensation for the CEO should be rational. I mean, we've seen businesses where, especially smaller companies where the CEO is getting paid, almost half the market cap of the business. Like, where does that come from?
After the market cap's fallen like 50%.
After the market cap's fallen, substantially. Like, you don't want to be partnering with those type of people. So it is important to know who your managers are. Because if you hire management, if you own a business, you want to hire a trustworthy management who's not going to rob you blind.
Yeah, and keep an eye on their compensation. That's a telltale. Keep an eye on their shareholders letter. Watch them in interviews.
Yes.
That's another way. It's there are ways as a smaller investor that you can kind of keep an eye on management. But I think that's probably as deep as we'll go into that, because we all know we're supposed to have good managers.
Well, I think it's a good point, though, because we did struggle with that initially. When we first began our investment journey, we're like, well, how do we know who's a good manager and who's not? And those are the ways that we found. Watch video conferences if you can. So the third pillar is reinvestment, and this one is going to be dependent entirely on the business and the industry they're in and whatnot.
But let's break down. There's two parts to the reinvestment
pillar.
Go
ahead. Yeah.
So it's how have they reinvested the money? What is their track history, right? It's one leg of the stool.
Yes.
But it's broken into two parts.
Sure.
So what is their track record on reinvestment? And then
that's a good point.
What else can they put their money into?
What are the prospects for the future?
Right. It's not just one. So when we studied Terry Smith, it was just what is, what has been, right?
Yes.
But for him, he very specifically broke it up into two parts. What have they done, and where can they go from here?
Right. So I think that's a salient point. So they're only going to be able to generate high returns if they have places to put money that they've generated high returns on in the past. So I think at this point, one of the things that Akre would be looking for is, again, as I mentioned, smaller businesses. So I think what they're looking for is smaller businesses, but in industries that have just kind of a wide open road ahead of them, really is what they're looking for.
And they're also looking for companies that are easy.
Yes.
Right? I think Charlie Munger talked about, I don't even know what company it was, but he said you want to look for companies where when they are using their capital, if it's a mistake, it didn't cost them too much. It's an easy fix. And he talked about an airline or an airport or something that made a runway.
Yeah.
It cost them exorbitant amounts of money and not one plane touched down on it. And he's like, that's a big, costly mistake.
Yeah.
He's like, you want to go into a company where if they make a mistake, it didn't cost them that much and it's easy to fix.
That's right.
And Chuck kind of got to that idea too. And it just triggered my memory on that he wants places where the investment is easy.
Right.
And they're able to figure it out. And that goes back to can you understand the business?
Right. Makes total sense. And so I think one of the other take-home points that he mentioned is these businesses are rare. And so at the end of the day, you're probably going to do a lot of research. So one of my take-home points from studying him is I'm going to be doing a lot of research and finding a lot of passes.
Or you should be.
I should be finding a lot of passes because if I'm studying 10 businesses and 6 of them look really appetizing to me, I mean, if these kind of things are supposed to be rare, these businesses are rare, then I must be missing something.
Right. Or you're you're tricking yourself.
I'm fooling myself. Is there something that I'm not seeing? Like, these all can't be wonderful businesses.
And also, he talked about like his ability to change his mind if one of the pillars isn't working. So he talked about a company that, you know, it seemed intriguing, a good business. They could understand it. It had good ROE. He's a big guy on ROE.
Yes. Oh, huge. Yeah.
Right. So Terry Smith was ROCE,
yeah,
return on capital employed.
Yeah.
And he's ROE, return on equity.
Yes.
So they all kind of go together, but they're all a little different. And there's another guy who was ROIC, and I can't remember who that was. We were talking about that, but. Anyways, he was saying like there was this company that he found, and then they talked to the manager, and they were like, and they started looking at the financials, and something was off.
Yes.
And they caught it, and they just changed their mind. They said, no, we can't trust you. You are not someone that we want to do business with. And sure enough, it came out later that there were definitely financial shenanigans. And he'd also run other companies where similar things had been done. So he was able to change his mind instead of making it fit. And I know I'm guilty of it. If I find a company that I like with decent numbers, I want to make it fit into my thesis.
Well, part of that as a small investor, and I'll say it's maybe one of my biases, is that you kind of fall in love with a company. You fall in love with the idea of a company. And then you've also invested a bunch of time.
I was going to say, you fall in love with it after you've put all that time into it.
Yeah, because if you've put in, 10, 20, 30 hours, the more time you put into it, the more you want to like the business. Exactly. Right? Because you spent all this time, you're like, well, I should buy it.
Opportunity cost.
Right, because that's time I could have spent doing something else. But it's made me realize that maybe I should be quite choosy on the things that I choose to invest in. And
no called strikes.
There's no called strikes.
And I think that actually might be, I've never identified this until this moment right now.
Good.
That might be a defining difference between the greats and the non-greats.
Interesting.
Is that they're actually able to study a company for 30, 40, 50, 100 hours maybe.
Yes.
And say, yeah, you know what? No. Where a lot of people, they feel like because they've studied it, they know it. Because they've studied it, it's a good investment.
Yes.
And maybe that is one of the defining differences. They can pour their time in and still say, yeah, no, not for me.
I totally see what you're saying there. I 100% agree.
So every time we study one of these great investors, I'm always taken back by how simple their strategy is. And it's always some sort of like buy and hold. It's always like only one or two metrics.
Yeah.
It's beauty and simplicity, but I think it's their psychological fortitude that really allows them to make these gains.
Yeah, I think having studied them, I think you're right. Like, psychology takes up a lot more in investing than I've previously given it credit for. And maybe we'll do a show on that one day. I think that would probably be useful. Our own psychological biases that kind of keep us from doing well in the market, or maybe we have strengths that lead us to do well in the market. Who knows? But I think maybe we should do that one day. That would be interesting. But one of the things I think as our closing point we should bring up is that I think it's possible for someone without a financial background and training and whatnot to become, a good or even great investor, as has been exemplified by Chuck Akre. He didn't go to business school. He didn't come from a financial background. I mean, he worked in the industry and obviously cut his teeth there, learned a lot there. But I think if you're willing to actually do some reading, have a curious attitude and spirit, and have a willingness to learn, I think you can do it.
Curious is also a word. You said curious, but he said that word a lot.
He said that a lot.
A few things, and he always says, we're curious, we're curious, we're
yes.
curious.
You have to have a natural desire to just look at the world and the way things work and study business and read broadly. That was the other thing that I understood about him, is he liked to read broadly. It wasn't just about business. Obviously, he liked business, but he would take lessons from other disciplines and try and bring them into his investing style and whatnot as well.
I think you said he actually said he'd bring speakers in.
Yeah.
Right?
He brings speakers in from other disciplines, who are very good at what they do. So he might bring someone who runs a very successful charitable organization or something like that and bring them in and learn from them as well, just as an example. So he's willing to learn across disciplines. And Charlie Munger was a lot like that as well. He was a very, very big proponent of learning across disciplines. The broader your knowledge base, the more you have to grab from to look at your investments.
Yeah, the more hooks you have.
Yeah, that's right.
Right, the more hooks. So his the three-legged stool, we'll go through them again, is the quality of the business, and he had different criteria for that.
Yep.
The management,
yep.
Are they good? Are they honest?
Yep.
And then the return.
Yes.
Where can they put their capital, and how have their returns on equity and invested capital
been in the past? That's right.
So that's everything for today. I hope you enjoyed the video. If you can like and subscribe, that helps our channel, and we will see you next week.